G'day, folks. Today I'm going to go through my economic predictions for the next 2 years. So that'll cover subjects such as real estate, crypto, and stocks. And I'll go through commodities a little bit as well, though that I have to concede as a market I don't follow particularly closely. So what I've got here, this is the 18-year real estate cycle, and it goes in a roughly 18.6-year real estate cycle, and my own personal thesis comes from that. So of course, none of this is financial advice, but basically, this is where I derive my conclusions for those that are interested. And it basically runs off a history that's lasted for over 200 years, and it's really reoccurred time and time again. And the analysts that I personally follow have made correct calls for 20 plus years, respectively. And they continue to call all the major market movements, both to the upside and downside. So for that reason, that's why I've come to the thesis across various markets that I have. So to start us off here, so you've got the 18-year real estate cycle. So essentially what we had in 2020 was the mid-cycle slowdown. So that's just really a short, if you want to call it, break of momentum, where there's a sharp bit of downside, but then with that you get stimulus, and then there's, of course, a recovery. So that's what we've seen. And as we currently stand, if we're to look at this, we're probably around this point. So we're in a market that's going up and has been for a little while. So if you followed this thesis, you would have been invested in the market last year, of course, and you would have been performing very well. And for those that want a little bit of additional insight as well, with 2022, the drops were expected for those that follow the Jewish Shemitah. So every 7 years there's a drop. So that's where we saw the drop in 2022. And of course, at the conclusion of that, that's when we saw the market start to rise. So for the analysts that I personally followed, that was the advice that they were giving out at the time, which happened to be proven correct. So, and that's really only, I guess, furthered how closely I follow these particular analysts and what they believe will be happening with the market ongoing. So no guarantees that everything is going to play out perfectly to how they believe, but yeah, I'm of the personal belief that history will continue to play out the way it has. And then again, based on this, I'm expecting a peak in 2026. So that will be basically, from there, we'll see an everything crash, which will go down for 4 years. So essentially, everything runs through the real estate cycle, and the real estate peak will be 2026. And then the question with stocks and crypto will be, does that peak happen around 2026? Maybe it happens a touch earlier, but it could be around that 2026 mark. We either see that peak or we start to see that drop begin. So basically with real estate, the key understanding is that every market is different. Not every market around the world moves the same at the same pace in the same way. So that's something that in real estate has to be strongly considered, because there are markets that in the past 12 months have gone up rapidly. There are other markets that have also contracted slightly. So you do need to be aware of that, certainly. But you'll be finding in the real estate markets where there's been significant building, they're often the markets where we've seen the most major growth. So, and in the lead up to the peak, we're looking for the world's tallest building or the world's most amazing this or that happening. They're usually indicators around when that peak will be coming, usually that conclusion date. And upon that conclusion, you'll find that once the world's tallest building has been built, well, you're going to have very little occupancy. So I'm expecting in 2026, for my personal conclusion, again, no financial advice, that we will be seeing an everything crash. So we'll be seeing from after that peak, we'll be seeing property crash, stocks crash. Crypto will go down substantially in 2026. I think with crypto, we might see the peak at some stage, probably late 2025 to hazard my best guess. Stocks could be around a similar period, but I believe property for the most part will peak in 2026. So that's my prediction there. I also believe that commodities will have a peak in either 2026 or 2027. And then from there, we'll see a big drop from there. talking predictions, if I'm to talk the US election, and I believe it will have macroeconomic consequences, my prediction at this point is that Donald Trump will likely be the next president of the United States. And with that, it does have consequences both to the upside and downside for that matter. To the upside, firstly, and this is just talking markets, I'm not too sort of bothered in this form of analysis to go through policies and what have you. But I believe from a market perspective, the difference with Trump coming in will be that we'll have taxes drop both on individuals and businesses, compared to, of course, what is the case under the Biden administration. And with that, we will see markets pump substantially more than would be the case. So we'll see the greatest peaks, and Trump will be going on about, these are the greatest markets I've ever seen. So you'll get all that sort of stuff. But then I think actually the legacy under Trump will actually be that with the 2026 collapse, that collapse will happen under his watch. And the more the market goes to the upside, the greater the drop will be in percentage terms compared to what would otherwise be the case. And I'm expecting this to be really the greatest crash since the Great Depression. I believe it will be a greater crash than the global financial crisis. So for me, from 2026, I will be, and this is talking for me personally, I will be taking a very conservative approach. But in the lead up, what I'm currently doing is I'm very aggressively invested in crypto, because ultimately in 2024, I believe it will be a mostly upward going market. And I also believe in 2025, it will be a very bullish year. So, and we'll probably see that peak come in at some point in 2025. I don't know when. I'm suspecting probably in the latter portion of the year. And to even estimate a month, I'll say probably around October, maybe December, but I'm going to say more likely October will be that peak for most of crypto. But of course, you've got different coins, of course, peaking at different times and what have you. So that's something to be aware of. But that's the rough timeline I'm at least going off of. So yeah, we'll have to see how that plays out. But basically, I'm just playing it based on history. With crypto, we've got a rough 4-year cycle that continues to repeat, and the peaks and troughs seem to occur with a particular rhythm. So that's taking all of that in mind. So, and given I'm believing that certainly 2024 and 2025 will be the most bullish markets, well, being in crypto, being the most volatile asset with a scope both to have the most upside but also most downside risk, well, I believe that that's, at least for me in my own personal situation, the best place to put my funds. So, yeah, that's sort of the way I'm playing it. But to go through the analysts that I trust and follow, and these are the only macro analysts that I really care much about, or adding on to them, others that share their general thesis around the 18.6-year real estate cycle. So firstly, we've got Phil Anderson. So he's the author of The Secret Life of Real Estate and Banking, and he's involved with property share market economics, but he also has another newsletter that I also follow. So yeah, make sure that you give him a big follow. He's, for me at least, sort of the foremost authority, particularly when it comes to the US and global markets. Coming before Phil Anderson, you've got Fred Harrison, and he's a key author who's written many publications that are absolutely terrific and also well worth a read. With Phil Anderson, I'll go back to him briefly. So he predicted the timing of the GFC. He predicted the timing of the mid-cycle slowdown, which was the COVID crash, essentially. And he's been predicting all the really even smaller movements, for that matter, really in between. So he's been absolutely phenomenal. And he understands the Schmieder crash. He knew all about that. So credit to him there. And you've got Fred Harrison, who predates Phil, and Phil got a lot of his knowledge and alpha from Fred. So Fred, his analysis has been primarily of the UK markets, but he also understands about the 18-year real estate cycle and has that full knowledge. So he's certainly someone else to follow, and they're both of the thesis that we'll see a really everything crash in 2026, and that's when we'll have the peak, and then yeah, things will go down from there. In terms of newsletters and publications to follow, Property Share Market Economics is a must. They've got a free newsletter. You've also got paid subscription services, up to you if you decide to get behind them. And you can follow them here. So you've got all the details. And you've got, if I go back a page, you've got the various plans. So you can just go the free one if you want, but you can also pay for different services, which you can see here. So yeah, if you want to try them out, just get some general alpha and get a bit of a feel for where things are at, well, yeah, you can just go the free newsletter. For me, I'm very much focused on putting all my funds into the market, and I have an understanding of the 18.6 year cycle. So given that, and given I'm not a huge income earner, well, yeah, my focus is more being fully invested. And then you've also got, again, Phil Anderson, but he also has the Signal subscription service, and he's with Rogue Economics. And on here, you've also got a lot of his other articles to follow. So essentially, if all you read is the free Property Cycle Investor content and then Phil Anderson's free content from Rogue Economics, which you can see here, really you're going to have a good understanding as to where we're at in the cycle, what are the things to look out for, what are the danger signs, what are the potential opportunities. Really, you'll have that holistic macroeconomic understanding, and an understanding well beyond what you'll be getting from whether it's the mainstream media or whoever the other commentators that are popular in the space are. And these aren't the only names to follow, but if you're to really limit down who are the absolute most important names, these are certainly the other names. But if there's others talking about the 18.6 year real estate cycle and showing clear understanding of it, there are other people certainly that I would advocate. So, yeah, so that's my personal take. Again, no financial advice, but do read up and do research the 18.6 year real estate cycle. It is well worth reading up on. And had you done that, well, for the last however many years, from Fred Harrison, he's been making predictions from probably the early 90s to hazard a guess, maybe even the 80s potentially. With Phil Anderson, from the 2000s, he's been predicting all the market movements. So if you've been following these individuals and following their cycle through those times, well, essentially you would be knowing when all the peaks are and all the troughs are and all the movements in between largely. So, yeah, so given that, these are the individuals in, I guess, the macroeconomic landscape that I respect and follow. So, and given, I guess, the understandings that I've learnt from my readings of them, both their articles, their books, that's allowed me to form the thesis that I'm sharing with you today, that a 2026 peak, and then we'll have a 4-year down period where we'll see an everything crash, and a pretty devastating one at that, will occur. I guess the one caveat, and this has been expressed as well by Phil and some of the others who are in the space that follow the 18.6 year cycle, is if anything is to disrupt this cycle, the most likely reason for that would be if there was to be the beginning of a World War III. If that's to happen, if I was to, again, this is hazarding a guess, potentially 2028 would be roughly the time that we could see that. And look, during war times, it's good for markets. But of course, it's fair to say I'm not an advocate of war, and I very much hope that doesn't happen. But that is something that there is reason to at least be aware of, and have an understanding that, yeah, look, there is the potential that things could escalate, where if you've got the major economies in a down period, and there's some economies or countries that believe that, look, maybe there's some opportunities within this to, one, stimulate our economy, and two, take advantage of the situation, well, yeah, there could be problems. And I'm also anticipating, aside from that point as well, there'll be a real dilemma in that with the everything crash, if you want to call it that, we'll have two different problems on our plates. So one, we will have the problem of debt. That'll be both at a household level and a government level, where there will be significant strife, and this isn't just isolated to the US, this will be a global thing additionally, but certainly in the US they'll be among the hardest hit, I'm suspecting. So that's something to certainly be aware of. But then the other thing is that also by trying to get out of, I guess, a major crash situation, well, what would potentially be happening would be you tend to get significant government spend. So you'll have lowering interest rates and significant government spend. And with that, we could see a period of significant inflation. So the real dilemma will be whether we see currencies basically hyperinflated into who knows what, or whether we see substantial, really collapses from a debt perspective, where governments and citizens get so indebted that there's significant problems. So it'll be interesting to see which way things go, how it's resolved. The only way to really get out of it is through productivity gains, and potentially in the next cycle, we'll see that. So this is from 2030, and this is looking way, way ahead. But usually with the next cycle, it starts with you get sort of tech booms and all that happening. So whether it's like AI, whether it's like automation, those are some of the things that might enable us to get those sort of productivity gains to, with some luck, get out of that without, too significant economic issues. So from whether it's that debt perspective, whether it's that inflationary perspective, where, so there's, I guess, the things to be certainly aware of. So I guess the warnings are heading into the peak, and this is the warnings by Phil and those others who are in this space and advocates of the 18.6-year real estate cycle. Phil's advice is really in these last 2 years of the winner's curse, heading into 2026, it's really about paying down as much debt as possible. And when we head into the peak, you really don't want during that collapse time to be over leveraged and in debt issues. Because ultimately, if that happens, well, if you've got property markets in whatever countries or cities you happen to reside, well, if you're going to get significant crashes and you're over leveraged, well, you could get some situations where people get stuck in negative equity situations, having to sell their properties, and you've really wrecked it for that next cycle, and you're in really devastating situations. So that's something to be aware of. And for that reason, and with that understanding that, look, property markets could potentially collapse after, really after 2026. Well, I really don't want to be in property certainly in Melbourne, Australia. Well, property's a negative cash flow, unfortunately. It's not a cash flowing market anywhere. In terms of actual buy prices compared to rents, it's terrible. So, given those understandings, and if there was to be that significant collapse, I really wouldn't want to be in that market. So ultimately, if I was to be buying into property, and this is, again, talking to my own personal situation, if I did really well through crypto and I wanted to get into a property for whatever reason, I would really make sure that there was a really insignificant level of debt heading into that crash, where any debt that I had left over would not matter at all, and that I wouldn't be in a situation where there'd be any chance at all of losing a property. So, again, to give a bit of insight into my own personal psychology and thinking around it all, that's, I guess, roughly my take there. But if you enjoyed watching, make sure you like, subscribe, and hit the notification bell for future updates. Give me a follow on Twitter at DorryInvests. I'd very much appreciate that. And I'll see you in the next video with some more crypto content, because at the moment that's my primary focus. But don't be surprised if I also include a few property and stock videos as well. But anyway, see you in the next one.